There's one stock that stands out as a phenomenal opportunity for investors right now, not only from a growth perspective, but also from a value perspective. So I'm going to go through the one stock that I am buying this month. This is one of the companies I bought in the Asymmetric portfolio. If you're interested in the full list of companies that I bought and everything that I'm buying at the beginning of each month, I'll put a link in the show notes to that. That's on my Asymmetric Investing newsletter. There is also a membership option here on YouTube as well. I'm going to dig into one of those stocks today, but that will give you a better idea of what that full portfolio looks like. But let's dig into my favorite stock of the month. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And of course, as I mentioned, check out the Asymmetric Investing newsletter. I'll be back in just a second after this word from public.com. All right, if you are serious about investing, you need to know about public.com. That's where you can invest in everything from stocks to options, bonds, and even crypto. They even offer some of the highest yields in the industry, like the bond accounts, 6% or higher yield that remains locked in even if the Fed cuts rates. What sets Public apart is how they give you the tools that you need to make informed investment decisions. Like their built-in AI called Alpha, it doesn't just tell you if an asset is moving, it tells you why the asset is moving, so you can actually understand what's driving your portfolio's performance. Now, Public is a FINRA registered, SIPC insured, US-based company with customer support teams that actually care. The bottom line, your investments deserve a platform that takes them as seriously as you do. You can fund an account in 5 minutes or less at public.com/ASYM and get up to $10,000 when you transfer in an old portfolio. That's public.com/ASYM. This ad was paid for by Public Investing. Full disclosure is in the video description. Now, the stock that I am most excited about was the biggest allocation in the Asymmetric portfolio this month is Lyft. Lyft is the ride-sharing company. They've always been known as kind of second fiddle to Uber in the ride-sharing market, but they've developed a really nice niche. And one of the reasons that I got attracted to the company originally in 2024 is I think they've got a phenomenal position in autonomous driving. So they have their traditional ride-sharing business. Yes, that's true. But as you think about the transition to autonomous driving, what is that going to look like? What are the partnerships going to look like? What are the players going to look like? And I think the ride-sharing business is going to be a real value point because they're going to be able to connect demand with supply. And I think that supply is going to be many more automakers than a lot of people think right now. I think there's going to be dozens of companies that are going to offer fully autonomous vehicles. What some of them can do is just plug into Lyft. Mobilize technology is going to make vehicles Lyft ready. So Volkswagen, the biggest automaker in the world, makes about 9 million vehicles. Every one of their vehicles that is chauffeur or their drive system is going to come basically able to plug into the Lyft platform. That's going to be a phenomenal position. They can also not only make more partnerships with companies like that, they have an easier transition from riders and human ride sharing to an autonomous business than I think Uber does. Uber is more than 10 times as big from a revenue perspective, and their business is going to have to go through the same transitions Lyft is. But if you think about a city that maybe has a dozen Lyft vehicles that are operating at any given time, maybe that's 120 Uber vehicles. Lyft can go, you know what, we're going to bring in 30 or 40 or 50 autonomous vehicles and we're going to replace all those human drivers all at once. Just a much easier transition. So there's two opportunities for Lyft when it comes to autonomous vehicles. One, I think the autonomous market is going to be about 10 times bigger than the current market. I think that's a pretty good estimate. You have a few things that are working in your favor there. Should be lower cost to be on autonomous vehicles. There should also be more supply. So there's just going to be more use cases. The other thing is that Lyft, as the number 2 player, has the opportunity to move up that stack. Instead of having, let's say, 10% of the market, maybe they have 30, 40, 50% of the market in the future. On top of that, their price to sales multiple for investors is about a quarter of that of Lyft. So you add all of these things together, and I think Lyft is in a really solid position strategically and from a value perspective. Let's go through some of their recent numbers because this is where I think things get really interesting. The first thing I'm going to show is the revenue, net income, that's in blue, and then free cash flow trends for Lyft. You can see that revenue is growing consistently since March 2022 quarter. These are all trailing 12-month numbers. Compound annual growth rate is 20%. Free cash flow is now positive $766 million over the past year. There's some ebbs and flows of that with some of their insurance costs and things like that. But we are now positive from a free cash flow perspective and even from a net income perspective. So the business is moving in the right direction, and that's what we want to see. But on top of a good operations, we also have a really good balance sheet. This is a look at the balance sheet as of the end of 2024, almost $2 billion worth of cash. Now, management did announce that they have a $500 million buyback program. That's a pretty good deal for a company with a $5.6 billion market cap, so it could buy back nearly 10% of the company at that rate. They're also going to pay down that blue portion, the $390 million in convertible debt. They're going to just pay that down with cash on the balance sheet. So that's going to reduce their leverage. Yes, it's going to reduce their cash a little bit, but their net cash on the balance sheet is still going to be over $1 billion. If you have another year like 2024, could be $1 billion in cash on the balance sheet and $500 million less in stock outstanding. So things are moving in the right direction for Lyft, and I think the value is too good to ignore. But the other thing is, I mentioned the autonomous driving strategic position, how that could make this a 10x market, and then Lyft could be in a really good position. CEO David Risher recently put out an interesting blog post that I think really laid this out in a way that I've been talking about here on Asymmetric Investing for quite a while. And he goes through here how the company is positioned, what he thinks the industry is going to look like long term. You have self-driving technology that needs to be developed and advanced. There's really only two companies, May Mobility, which is a Lyft partner, and then also Waymo, who are actually on the road with full self-driving technology. You got to build out that manufacturing capacity, and then you got to figure out who's going to own the vehicles and who's going to manage the fleet. A couple of questions that are maybe bigger questions to answer long term for the industry. And then what's the platform going to look like? Is Tesla going to build its own platform and attract its own customers? I really question whether that's going to be the case for them. But Lyft already has this business, so it puts them in a really good position. And when you scroll down here, this is what I think is ultimately most important for investors, is where Lyft sits in this market. You have all of these pieces of the business that need to be built out. So how is this going to look in the future? Well, Lyft is telling you they've got strategic partners for self-driving technology, manufacturing, financing, and fleet management. They recently announced a deal with Marubeni, who is a financing company that's going to be able to finance vehicles for fleet owners. So that's, again, Lyft doesn't want to own those vehicles. They don't want to be the financing company. They just want to connect supply with demand. So somebody else is going to build a business on top of that kind of financing. That's going to be one of those strategic partners. So they're going to be able to connect customers and suppliers with those kinds of deals. And they're going to be able to do things like fleet management. This is the FlexDrive company that Lyft owns. FlexDrive was originally basically a way to facilitate people who didn't have a vehicle or didn't have a Lyft-ready vehicle, basically be able to rent a vehicle from Lyft. Uber had a similar deal with Hertz, and then they would have to be able to do things like maintain those vehicles or finance those vehicles. So they have this infrastructure. I think there's about 25 of these in the US, and that's something they can lean into when you're thinking about charging vehicles on a daily basis, keeping them clean, maintaining them. So this is the kind of capability that if you're a fleet owner, maybe you say, hey, I want to buy 10 Lyft ready vehicles, put them on the Lyft platform, but I don't want to be in charge of operating them on a day-to-day basis. You can lean on a company like FlexDrive, which is part of Lyft, and there's also going to be various partners. This is them telling you that they're going to be commoditization in the self-driving business, because they're saying, hey, there's going to be a lot of players with self-driving technology and vehicle manufacturing. So I think Lyft sits in a pretty solid position strategically. Now they've got to grow this business and they've got to expand exponentially when we get to a fully autonomous world. But I think this is a really compelling company, because I don't think many companies are going to build a new ride-sharing platform. You're going to be building on top of the existing ones, that is Uber and Lyft. So what Lyft has is a really nice, solid business today. As I'm recording, shares are trading for just 12 times forward earnings. So that's really a value stock, not a company that's growing consistently over time. But we've seen that Lyft has been able to grow. I think has much more of a niche position than Uber, but that's okay when you're in the ride-sharing business, as long as you're able to make money year after year. I think Lyft is in a very good position for that. And then strategically, as we look at what the autonomous vehicle world is going to look like, I think Lyft is in a really good position to basically burn the boats and say, hey, you know what, we're going to go all in on autonomy. We're going to increase our supply in markets by 10x, try to attract more and more riders, because again, this is a business that is driven by supply, not just demand. If you open up your Uber app and it's going to be a 20-minute wait, might as well check, what's the wait for Lyft? Oh, it's only a couple of minutes. That's going to attract more and more riders to that platform if they're able to get that supply into the market. So I think Lyft is a really good value stock today. And the asymmetric potential is they get this right in autonomy. and they're able to build a 10x, 100x more valuable business than what they have today. This is what asymmetric investing is all about. Limit the downside and have unlimited upside. So that's why I think Lyft is a phenomenal stock today. If you want more of my picks, go to Asymmetric Investing. There's a link on the screen, also a link in the show notes, and then I'll have a link for the portfolio as well. You can keep up to date on everything I buy every single month. Let me know if you have any comments or questions about Lyft or asymmetric investing in the comment section below. Thanks for watching, everybody. See you here next time.